So the basics of 1031. So what is a 1031 exchange? Fundamentally, we can talk about it a bunch of different ways. It's a series of real estate transactions. It's nothing more than that. So it's not a structure. Last week we talked about syndication, which is a structure. It's just a series of transactions. Nothing to get panicked about. I'm not going to get into this right now, but people say the rules are complex. I will tell you that closing a merger or acquisition is pretty complex, but it's basically 45 days to identify and 180 days to close. I'm going to tell you ways around that, but that's basically what it is. What does like kind mean? What can I swap? So the definition is actually pretty broad. It can be investment, vacant land. It can be apartments. You can swap apartments for commercial. You can swap 1 for 2, 2 for 1. But what it won't do is allow you to transfer personal assets or business interests. And primarily what I'd like to say there is intangible value. So section 197 of the tax code is where goodwill is found. And for those of you who have successful businesses that are valued on the income approach, the majority of the price that you will receive for the sale of your business will be intangible value, and those are not deemed like kind. So I want to point that out. Really, when you think about 1031, it's a matter of timing. Coincidentally, whoever's moderating, I'm not paying direct attention to comments. I'm just kind of going through. So the 45 days, it's got to be done in writing, delivered to a qualified intermediary. We've kind of covered this already. 180 days to complete the purchase. So I think everybody understands that now. What is a qualified intermediary? Because I think we all know what qualified means. It's the opposite of not being qualified. And an intermediary is a go-between, so we get that. But it's a middleman that stands between you and the process. And the title company stands between you and the process of doing a transaction directly with the seller in a non-1031. So although it's not identical, let me just describe it as the escrow person, the intermediary, the middleman. To make it more real for you, I wanted to show you some websites of exchange qualified intermediaries. So First American Title has an exchange company. Asset Preservation Inc. has an exchange company. Feel free to check any of these people out. We have no relationship or what have you with them. They're just some of the largest in the industry. IPX 1031. Just leaving it on there so you guys can write down the website if you want, but feel free to contact Michael Kimbell. He'll help you. What do we mean by equal or greater value? We get a lot of questions here. So you have to buy a property that is equal or greater than the value of the property that you sold. And I know that still doesn't answer all of your questions. It's like, is it the money I put in? Is it the property value? I just told you it's the property value. What does that mean? I think as we go through the presentation, I think it's going to become very clear for you.
Well, Pat, can we just talk about that real quick, just to plant a little bit of a seed? If you put $1 million down and your property appreciates and you sell it for $4 million, typically you need to buy $4 million. You need to put that $4 million into property. So whether you buy a $4 million property outright, or whether you put that $4 million in a couple deals, 2 million, and get a couple deals out of it, or you put that $4 million down payment, and let's say you would get, buy an $8 million property. Whatever you exit with, you need to put in. But so whether you pay off cash or whether you leverage it to get a large property, with what you exited, in general, I just want to leave people with that.
So I did have a second to look over, and thank you, Jason. So whoever is anonymous and asked that question, it's the property value, not the equity. So appreciate your engagement.
Yep.
So what happens if you don't perfectly match up? Do you go to jail? What happens? The difference is boot, and so it's taxable. And you go, God, I did this deal. I wanted it to be a tax deferred exchange. Now I've got boot. I have no idea why they call it boot. Jason and I talked about this today. I think it has to do with putting money in your boot and walking away with it. I was a CPA with Arthur Anderson. It's the best explanation I have. But any portion that doesn't qualify, you still qualify the rest of it. So it's always a benefit. It's just a question of whether you have something left over that's taxable. Does that make sense, Jason?
Yeah, it does. And I'd just like to say it another way. So let's just use that same analogy. You put $1 million in, you exited with $4 million of the sale. And what Patrick is saying is, if you only decide to put $3 million to work, 1031, the $1 million you would pay the capital gains tax if you decided not to do that, or couldn't find a property, for instance, like maybe Michael Grandjean was saying, if you're doing it on your own, you don't find the property, you're desperate, you don't want to pay all taxes. So on that $4 million property you just sold, you found a property just for $3 million, for instance. Whatever you don't put from your prior property towards a new deal would be taxable. What we find, and I want to say this right here, we talk to clients every day that work with us, and one of their mottos is 1031 for life. And we're going to show you what that does later on, and then I'm going to bring up that phrase again. But so if you put in all your money from your previous exit, there's no tax, no capital gains paid. If you decide not to put all your money, you will pay the difference you'll pay the capital gains on the money that you did not invest. Short story.
Yeah. Okay. So what types are there? We're going to get into this now. Simultaneous exchange. How does this actually happen? So imagine you have two totally liquid cash buyers and sellers. Maybe they even know each other. They want to do a 1031 exchange. Neither one's hot to trot to sell. And they go to a qualified intermediary and they do everything at the same time. Okay. That's not a big percentage of 1031, but that's what that means. Delayed exchange. This is what most people do. So it's the most common. So you sell your property, you got 45 days to identify and 180 days to close. Does that mean that you actually have 45 days to identify? Somebody asked this earlier. Don't go over 45 days because you'll blow it. But while you're selling your property and you're in due diligence, you might as well commence your search process. So I would argue you have 90 days, because you shouldn't wait until the absolute day that your deal closes to start to identify your next property. I think that would be a mistake. I want to talk about these next two get a little complicated. I'll try to keep it as simple as possible. The reverse 1031 exchange. You go, what do you mean? You can sell your property to what's known as an exchange accommodation title holder, which is an LLC that's owned by your qualified intermediary. You go, oh my God, you just lost me. Okay, just think about this. You sell your property, but you buy a property and you don't have everything worked out. You can do it through the qualified intermediary in such a way where you're not quite as foot to the fire to get everything done at the same time. And I thought about it. I'm happy to talk about it in more detail, but I don't think it'll be beneficial for the entire group. And I'd prefer to speak one-on-one with folks or someone from the team do that to help you understand. The next one is a construction or an improvement exchange. And basically, if you thought about it, if I gave you numbers and you needed to exchange a certain amount, but the property you're buying is short, as long as the improvements take place in 180 days, you can work those in. And the way you do that is the money goes to the qualified intermediary and they deploy the rehab or the value add. I'm going to be super complicated now and say you can do a reverse construction improvement exchange. And so you can reorder how everything happens and yet improve your property. Again, we're getting kind of advanced in the 1031 space, so that's not the point of today's presentation. It's supposed to be fun and light. So what are the pros? The main advantage is the deferral of tax, which significantly increases your buying power, especially over time. Leverage, it allows you to leverage more of the property instead of sending some of it to Uncle Sam and putting it in your next deal. Diversification, a little more esoteric, but it allows you to either sell multiple properties for one, or one for multiple, or two for three, in ways that don't trigger immediate tax consequences, but allow you to rebalance your real estate portfolio in a way that you individually think suits your needs. This is actually a big one. And I toyed with a picture of somebody in a casket, and I decided that a small child was more important, because it's not about estate planning, it's more about legacy. This is the best and the worst tax planning method out there. All you have to do is die. And all this deferral you've been doing with 1031, when you die, if it's set up properly, your estate gets what's known as a stepped up basis. So they undo all the depreciation, and whatever the fair market value of the property is, that's what your heirs receive the property at. And the negative is you won't be there, but it's a huge wealth accelerator, and it's a way for you to make an impact for generations to come. Cons. I think anyone in the industry will admit that it is very difficult to come up with a con for something. It's like coming up with a con for 401k plan. I guess the con would be you don't have immediate access, but in a 401k plan, but there's not a lot of cons. There's no reason not to do a 1031 if you can qualify for one. But I don't feel comfortable speaking only about pros, so I tried to come up with some. And Michael, our guest tonight, talked about this, and that is, can you find something in the market, or does it constrain you? Because investing well is investing when there's a little uncertainty. When there's no uncertainty, the problem becomes competition. And so you need to make sure that you can identify a property that meets your needs at that time. The other is, obviously, as you're trading up and expanding your portfolio, whether it's diversified or not, either way, you're taking on additional debt. And I don't want to skip over that. I think a lot of people who talk on this subject, they treat it as though there's nothing to it, and it's kind of like trading options. You should take as much risk as you'd like. You should not. You should respect the fact that there is financial risk that's associated with leverage, and you should manage it accordingly. So I'd like to say that. But that applies whether you do a 1031 or not. So it's really not a 1031 con. The other is that if you don't hit the equal or greater criteria, you have boot, which is taxable. But what I would say is, let's say you don't cover it all and you only shield 70% of your tax. Okay, is it a con compared to shielding 100%? It is. It's still better than not using it, but I wanted to put that in there. And especially if you're a new investor, you can think it's complex and the timing's hard and what have you. I can tell you, like, selling a business that's got multi-divisions and across multi-states is complex. These qualified intermediaries are very competent. You know, we have nothing to do with them, but they do this every day of the week. So as complicated as it is, they will walk you through every step. We will too, but they will walk you through every step. So why do investors do 1031 exchanges? Primarily to defer the capital gain tax and reinvest it, instead of sending it to Uncle Sam, reinvest it and take on debt. And when you take on debt, you're kind of on the same trade as the Fed. So if they print money, your debt gets depreciated. So the reason they do it is to defer tax. Example, I used a bike kind of as an analogy to training wheels. We're going to go through a very basic example right now. I'm going to hang on this slide, even though it's not super exciting. I want you guys to get it, because if we pass over it and you don't get it, then I haven't served you. So let's say that you buy a commercial property for $3 million, and over some number of years, you have $1 million in depreciation. Okay, there's a tax concept called basis. Okay, basis is what you paid. You buy Amazon stock for 100, your basis is 100. if they pay you a dividend, your basis is what you paid minus the dividend. Okay, so you bought it for 3 million, you have $1 million in depreciation, your basis is 2 million. If you guys want to sound fancy, it's called adjusted basis. And then if you sell it for 5 million, your gain is going to be the difference between the 5 million you sold it for and that adjusted basis. Hopefully everybody's good on this. I'm watching the comments. Okay. So now let's look at taxable versus non-taxable, and you'll see why I made this slide versus the next slide. So what this slide is supposed to signify is that you got a promotion, you went out, had a great time at the bar, and you thought it was on the company, but at the end they gave you the tab. So that's equivalent to doing transactions without 1031. So your capital gain would be the 5 million that you sold it for minus the 2 million in basis is 3 million. It's going to result in 800,000 in taxes. How? The portion that you depreciated, the $1 million that you depreciated, is taxable at 25%. You don't want to know this, but it's under section 1245. The remaining gain, which is 2.75 million, is 20%. I'm ignoring net investment income tax, but again, I'm not trying to be too geeky on this presentation. So now is the non-taxable exchange with 1031. So you got a promotion, you went to the bar, you had a great time, and the company picked up the tab. So you defer the entire $3 million of gain. And I don't know that carryover basis is necessarily a benefit, but what I wanted to say is, as you do these exchanges, whatever basis you had in the first property goes to the second property. And then as that one's depreciated, it goes to the third property. So it's, again, if you want to talk CPA talk or tax talk, it's called carryover basis. Everybody got that? Okay. So now you're going to finally dispose of the replacement property. And I'm going to give you two scenarios, and one is the taxable sale. If you eventually sell the property, you will pay capital gains tax and depreciation tax on both the original property and the depreciation property. And I'm trying to think of why I chose this background, but I can tell you that as a child, I collected comic books and I probably should have held them the whole time. And this particular cover I drew, and my wife was kind enough in one of my home offices to frame what I drew from my mom, and I thought it was really cool. If instead you go to the legacy and you pass it to your heirs, as we said previously, you will get a step up in basis, and your heirs have two choices. You know, you started with $1 million, you rolled it. Now you have $100 million, whatever you have in real estate. They can either reset the cost of depreciation and keep it going, or they could sell it all, and their basis is going to be equal to the fair market value on the date of the transaction. So they're going to owe very little to no tax, possibly even trigger a small passive loss. And then they might want to reinvest in something else, or some real estate, or whatever. But this is definitely 1031 helps you protect your heirs. Okay, so the reason we said secret and we put it in quotes, it's not because it's a secret, because it's not. The secret is that most people don't understand that it's the combination of two forces that make it powerful. So one is that you get bank leverage, and the second is that you get tax deferral. And so you can get tax deferral with a 401k plan, but no bank's going to give you 75% loan to value on your Amazon stock, and not also subject you to a capital call or margin call. So that's what's so special. I'm going to jump for a second, Joe, the difference between a 1031 and a trust. A 1031, back to that original slide, is a series of transactions, and a trust is a method of owning the real estate itself. I've had the question asked before, if I set up a trust, is it going to screw up the 1031? If you get a good estate planning attorney, there's no reason why you would pay extra to go into a trust only to blow your 1031 benefits. So a trust is a way to avoid probate in the revocable sense of the word. In the non-revocable sense of the word, it also affords credit protection, but that's beyond the scope of this particular presentation. So how does your net worth, if your cash flow, your appreciation, and the debt that your tenants pay down graciously on your behalf, how does that work if every 5 years the combination of that is 2 times? Well, your million turns into 2, turns into 4, turns into 8, and then it turns into 16. On the right side, if it's taxable, and you can call it stock, or you could just call it real estate that you didn't use a 1031 on, all I'm showing here is that you would pay tax, and 20% tax on a 2 multiple is 0.4, and so it doesn't accumulate as fast. Jason, you were going to add something.
Yeah, I just want to make sure, because this is where it starts to come home. You know, I think that there could be some things that people don't understand, but these next few slides, in my opinion, are really going to show you how through 1031 you can accelerate your wealth. So what I wanted to just say in this example, because it kind of builds on the others, we're saying that you put in $1 million of equity, okay, a down payment. And in our business model that we bring to our investors, you know, basically at minimum, you're going to 2x your money every 5 years on an exit. Now, by the way, you own these 100%. You can do whatever you want with them. You can hold on to them forever. You can sell it in 6 months. But we just show a 5-year exit and a 10-year exit in general, so you can see what happens. And we're using very conservative, a 2x. And it's always about your capital, not the size of the deal in general. So if you put in $1 million, that's the initial investment. In 5 years, it'll be 2. In 10 years, it'll be 4. In 15 years, it'll be 8 at 2 X's. In 20 years, it's 16. And if you live long enough, or if you start young enough, in 25 years, that's $32 million of equity from your $1 million. Now, for those of you out there, and now you see, if you bought it and sold it and didn't 1031 and then you paid your taxes, you can see the difference in 20 years of what you make versus 1031. Now, 2 things I want to say here. For those of you who say, well, I don't have $1 million, it's okay. They basically scale the same, meaning if you started with 500,000, you got started with 500,000, just cut this in half. Yes, in 20 years it's 8, but in 25 it's 16. And you could leave that a legacy. Okay, but before you do that, let me say this. Oh, I can't wait 20 years to touch my money. That's a long time. Well, yeah. But there are some other options out there. And one of the things that I want to say, which many investors do, just to kind of give it there, is, you know, let's say you're 10 years into it, 5 years into it. I got $2 million of equity. I got $4 million. You can borrow against the asset, typically 80% loan to value in general. You could extract that liquid capital, okay, and that is tax-free. So some people extract it, keep the asset, and invest that liquid capital, or spend it, or both. You don't have to wait, just in general. But we just wanted to show you here in this slide, first of all, understand it. Second of all, see the power of how to grow your wealth. And I also just love the example again with $500,000. Your $500,000 can be $8 million in 20 years. It can be $4 million in 15, 500,000. And on a lot of these leases, and if you get into the right investment, you're not doing anything on these absolute triple nets. Like Mike said, you're collecting checks in the mail, all right, et cetera, et cetera. So this is the beginning. Even though if you didn't understand some of those rules, we can share that with you. We can run it by you again. You can make an appointment and talk to one of the advisors. But one, it's getting started, quite frankly. You got to get started. You got to invest. And two, this is the beginning. So I wanted to just share this basis to make sure everybody understands so far as we start to build this. Let's see. Ladies and gentlemen, we want to answer your questions. Any questions? Let's take a look here. Mike, let me know if we see questions. It looks like there was.
I know that we have some investors. I don't want to call them out, but we have some investors on here. Let me see if some of them are still on here that are in the process of a 1031 exchange. One of them just jumped off. He just texted me. He's going to set up a call. I think it's important for us, like the properties that we showcase tonight. I have an appointment that is actually being set up right now about the properties we're showcasing tonight. I think it's important for the investors on the call to really ask about the 1031 exchange options, right? And really how that correlates into accelerating that wealth. So I just want to open the door one more time. If there's any investors that have any questions about the 1031 or even on the properties themselves, please take time. We're here to answer those for you guys. Patrick, you got a question?
Yeah. So I answered a question privately, and I just thought I'd repeat it. If you guys answered it, fine. Then you guys will hear it again from me. What's the significance of cap rate and NOI? So the property value is NOI divided by the cap rate. I'm going to say that again. The property value is the NOI divided by the cap rate. What that means is if you paid cash for the property, what would you pay for the NOI? Okay. And of the four mathematical functions, addition, subtraction, multiplication, and division, division's the hardest. So what I'll say is the cap rate is really like the inverse of the profit multiple. So a 10% cap rate is a 10 multiple on profit. So I want to make sure that's foundational knowledge. I want to make sure everybody understands that at the most basic level.
Okay.
Somebody asked, how do you underwrite tenants? So it doesn't matter whether it's an office building or a retail building. What we try to do is, well, I'll give you like some of the steps. First thing I do, I go to Yahoo Finance if they're publicly traded. If they're privately owned, it's a totally separate process, requires a lot more subscriptions and costs. But I'll go and I'll look at the stock chart. Then I'll look at the financials. Then I'll look at does cost of goods sold or cost of services provided increase or decrease? How is SG&A, sales general and administrative, moving? I'll look at, I'll listen to earnings calls. I'll go to Seeking Alpha. I'll see what other people are saying about the tenant. I'll interview the CFO. I'll interview the CEO. I'll tell the CFO and the CEO, you don't win by beating people up. What I'll say is my clients are going to ask why you had to take an impairment loss against your acquisition because of a regulatory change. And I need an answer for that. And I'm not trying to put them on the spot, but we're trying to ask the questions that you guys may not know to ask. So that's how we do that.